Good evening, everyone. Welcome to our UF Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for taking time out of your busy schedules to join us for tonight's class. We have a jam-packed class for you tonight. Run time for tonight's class will be just about an hour. I know a lot of us are starting to kind of file into the Zoom room, so I'll let everybody get into the session. We are recording tonight's class. So after tonight's class, we'll have the link available up on our YouTube channel tomorrow. Also, all of our presentation material that I share with you this evening will be available to you tomorrow morning. Since you've signed up for this class, you'll have access to all of the resources that we go through in tonight's discussion. Tonight's discussion is a very interactive session. So as we go through various topics in tonight's lecture, feel free to use either the chat or Q&A function in Zoom, and I'll be sure to kind of have those windows up on in front of me. I'll answer any questions that come up from the group, and then we'll get those kind of played back for the rest of our audience tonight. We do appreciate you taking time out of your busy schedules again to be with us. This is our second installment of 4 classes that we're going to teach for UF, and we've already had a really great response from the community across the country with some of these lectures that we're providing, and just giving our communities essentially the tools and resources to discover what homeownership could look like for them. Now, I work for an organization called American Pacific Mortgage. We're the 9th largest lender in the country. I am privileged to be one of the top originators in the country. And I do so by kind of using our educational platform to help educate buyers on really what their choices or options look like when they pursue homeownership. So, a lot of what we talk around tonight is going to be around kind of preparing for homeownership. And this is kind of what our talking points will look like for tonight's class. We'll spend some time looking at the housing market in just a bit. We're going to try kind of just do a quick little assessment of what the Florida market looks like. Now, certainly if you're in other markets across the country, we can have some conversations around what those look like, but there's a lot of similarities across the country right now in various states. We'll also spend some time looking at interest rates and what's going on with interest rates. So today is not a financial markets open day, so interest rates aren't available today, but we'll give you a sense of what we've seen in interest rates over the last several days and maybe some kind of forecast on a move forward basis. Also take a look at credit and how do we prepare and build for home buying. We'll also talk about loan programs and some of the choices that are available to you. Now, when we think about home ownership, preparing for home ownership usually involves savings for home ownership. So we're going to walk you through what documentation we generally need to validate when it comes to savings for home ownership, as well as some plans around savings for home ownership. And then we always talk a little bit about first-time home buyer programs. So wherever you're at across the country, there's generally some assistance resources available to you. So in various parts of the country, there's organizations called housing finance agencies catered towards supporting low to moderate income households in home buying. So we'll talk a little bit about some Florida available programs. And of course, if you're in a different part of the country, we can kind of spend some time looking at some of those tools. And then we'll walk through the buying process tonight. So if you're thinking about pursuing home ownership after tonight's class, we want to give you kind of the next steps of what your action items would be as a future home buyer, and talk a little bit about what a consultation when you work with us might look like. Okay, so that's our plan of attack for tonight. I'm really excited to be with you for this class, and I'd encourage you, if you do have questions as we roll through tonight's session, don't hesitate to drop those questions in the chat function or Q&A within Zoom. And like I said, I'll get those answered for you on air. All right. Well, let's talk a little bit about owning a home. And, does it really even make sense for me as maybe an existing renter? Maybe I'm still living at home, whatever the case may be. When we consider home ownership, it's probably going to be one of the biggest purchases or financial decisions we decide to make. Now, when we do purchase a home, there's a lot of great benefits that come along with owning a home, like the ability to be able to kind of control my own budget. So, as maybe rent prices increase, your landlord's probably going to also increase your rent. Well, as a homeowner, we're kind of more of in a fixed payment, so we're not subject to do all those market changes that you might see as a renter. Now, many of our buyers that are purchasing in today's market are probably purchasing at elevated interest rates because we're still at higher interest rate levels. However, over the next year or two, maybe 3 years, they're going to have opportunities to refinance their home in order to help bring down that monthly budget. And that's one of the benefits of being a homeowner, where you can take advantage of lower interest rate markets whenever that time comes in the housing market. Now, this is an asset, a lot different than buying a car, right? This asset should grow over time. That's called appreciation. So as my home value goes up, as I continue to pay down my mortgage, the difference in those two numbers is home equity. And for most of us across the country, that's our number one asset that we have. And it can be a real big game changer for many families across the country. For most of them, it's going to have the opportunity to potentially create generational wealth. So buying a home is obviously a big deal. And there also comes along with it tax benefits in owning a home that we don't realize as renters, potentially tax deductibility of interest on my mortgage. And when I decide to make maybe some energy efficient improvements to my home, I can reap the benefits of potential tax deductibility with that as well. So when we think about home ownership, there's just a lot of great attributes that come along with owning a home that, again, we don't really see as a renter. Now, to kind of frame that up for our class and to kind of launch us into our discussion tonight, I thought I would share with you a rent versus buying calculator, really kind of showing you what's the difference of continuing to go down the path of renting versus what could it look like if I decide to purchase a home whenever that time might come. Now, markets change all the time, right? But when I decide to make that financial decision and purchase, what could it look like for me? Now, this is an example of a rent versus buying calculator that we have available to our clients. And we're going to send all this presentation material out to you tomorrow, as I mentioned. But I thought I would just kind of walk our audience through just a quick exercise of a rent versus buying scenario, just to help you kind of better comprehend what the comparisons could look like. So in this kind of calculator we have here, you can see we have, a price of a home estimated at like 425. We're going to learn a little bit more about loan programs in just a bit, but for first-time buyers, the minimum down payment is 3% to purchase a home. We also, when we think about how much we'd finance, that would essentially be 97% of my purchase price. We have an average interest rate here, and then generally most clients are going to elect a 30-year fixed mortgage term. Okay, so we kind of plug that into a what if you will, for what the home ownership side of things look like. Now we're going to compare this to someone that's paying rent around $2,000 a month in rent. Now, if we were to purchase our home, we kind of put a what if in July of this year. That particular buying scenario with 3% down carries with it what we call as mortgage insurance. And we're going to learn a little bit more about mortgage insurance tonight. When we think about buying a house, there's expenses like homeowners insurance and property taxes. Those also get factored into our calculus of owning a home. And we compare that versus renting. And you can see some of the costs here. And so we kind of plug in some annual costs in terms of maintenance cost. Ultimately, at some point in time, when we think about owning a home, we'll probably consider selling our home. Maybe it's the forever home, but we have selling costs of our home. And then, as I mentioned earlier, this is an asset that should appreciate over time. And so if we were to assume maybe appreciation of maybe 3% on an annualized basis, that market value of my home will continue to grow over time. So what I thought I would do in this analysis, just to give you a high level look, is to say, okay, if we continue to pay $2,000 a month in rent and our rent goes up 2% on an annualized basis, versus if we decide to own a home for the next, we'll say 7 years, or let's just say 8 years for this exercise. If we continue to rent for 8 years versus own for 8 years, here's what our calculations tell us. So basically, if we decide to, after 5 years is kind of the break-even point where we're going to start to reap benefits of owning versus renting, because in the first 4 years, it probably makes a little bit more sense to rent because ultimately my mortgage expense is going to be more expensive than renting. But when I factor in the appreciation of my home, potential tax deductibility benefits of owning a home, that's where owning a home can outweigh the benefits of renting. So here's kind of what our analysis tells us. Our net spend right now, if we look at, let's see, an 8-year analysis of owning versus renting, if I factor in my appreciation of my home and my tax deductibility benefits, right now the delta, so my net gain of owning a home over 8 years versus renting is about $32,000, even in today's high interest rate market. So that is really just from a pure cash perspective, that's where I would be ahead after 8 years. Now, what we also need to factor in is we have equity appreciation. So my total equity, assuming that appreciation rate of 3% on an annualized basis over the next 8 years, now my home value potentially increases by $171,000 over that 8-year span of time. So when we think about home ownership, and as I consult with clients, we're going to factor this into the calculus because while we want to, keep our budget into an affordability level for us as future first-time homebuyers, we also got to look at the future upside benefits of owning a home And I think this calculator does a really good job of framing that up. I would encourage you after class, if you do have some time tomorrow, take a look at plugging in your own example. You can utilize these tools to really kind of see what homeownership could look like for you. Now, in this same link that we'll send over to you, there's also some different tabs that you can kind of take a look at. Affordability is another one. Like, where should I be buying affordably? Proceeds of my home after I sell, and then refinancing is a little bit further down the line. But so check out some of these calculators. I think they'd be super helpful for you. If I had more time in tonight's class, we'd certainly walk you through all of them. But spend some time kind of navigating through those. I think that would be really helpful for you as you consider home ownership. So that's our rent versus buying calculator. And that really kind of helps us understand really comparing budgets, right? Now, the entry point to how the housing market is going to be another important point too, because the housing market does cycle over time. Generally, it's housing markets cycle every 8 to 10 years. Now, when we look at across the country, we are starting to see inventory stack up a bit. So we're seeing more supply for buyers. Buyer demand maybe is not as high as we would like it to be because maybe where we're currently at from an interest rate perspective. Now, the Florida housing market is one of 4 markets across the country with the highest level of inventory. You can see average days on market across Florida right now is over 2 months in inventory stacked up right now. So I would say that, in the Florida market right now, we would consider that a buyer's market. Now, there's aspects of, homeowners insurance pressures on the Florida housing market that is leading to a lot of the stack up of inventory. But for those buyers that are financially ready to enter today's market, I think there's really some great opportunities in the Florida market right now. We have several buyers that are looking in, whether it's the Gainesville market or going further in the South Florida market. We're seeing a lot of buyers active in that market because they do realize there's an opportunity over here. You can see kind of the median price has been fairly flat, right? Maybe a slight little uptick as of recent, but really generally pretty flat. And so that market in Florida looks, similar, but not exact to what the rest of the country looks like. So the rest of the country has a stack up of inventory a little bit right now, but homes are certainly staying on the market a little bit longer in Florida. Now, the other 3 states that are the top 4 inventory markets are Texas, that's Georgia, and that's Colorado, along with Florida. So that's kind of what we're seeing in today's market. Now, across the country right now, 44% of all transactions have some type of seller concession, meaning the sellers have said, hey, you know what? We really want to sell our homes. So we're willing to make some type of concession and maybe credits towards the buyer's closing costs or reduction in prices to help make that transaction work. So I would say that points to another encouraging sign for buyers that maybe we're now pivoting from what we've seen for the last 3 years of a seller's market to more of a buyer's market. Now, interest rates still remain high, right? So we're still in the high 6s, as you saw in our rent versus buying calculator analysis. But I think even though we're in this higher rate market, as things cycle down, and they eventually will, there's an opportunity for many buyers in today's market, again, if they're financially fit and ready to go, because that inventory kind of surplus can lead to those opportunities. Now, today's interest rates are hovering around 6.75 to 6.8, depending on where, what day we're in the market. Today, the markets are not open due to the holiday, but markets will be back online tomorrow, and we'll see, markets change by the minute. We still remain at very high interest rate levels, attributed to a few key factors. The Federal Reserve is keeping interest rates still high because they're trying to manage down inflation across the country. Currently, the inflation rate is 2.4%, but the mandate by the Federal Reserve is to get our country to 2% inflation. So we're still a ways away from that. The Federal Reserve just came out on Wednesday, so just yesterday actually, announcing that they made no rate cuts to the federal funds rate. We'll see if they do at the next meeting in July, if we can get a potential rate cut. But they're going to be watching what inflation's doing and, of course, watching what the labor markets are doing. Those are kind of the 2 big factors that will weigh on what interest rates do. Now, we have a very dynamic interest rate environment right now because it does change by the minute. And obviously, we have things going on. There's some global pressures out there with what's going on in the world today. And so, that can move the markets and interest rates. And so we still remain very volatile in markets. I do think we'll eventually see interest rates start to tick lower, but it's probably going to take us through 2025 at these higher interest rate levels. And then as we move into 2026, we should hopefully see interest rates start to ticking lower into the low 6% range. And eventually we'll start get to more normalized levels. You can see over the last 20 years, this is kind of a snapshot of interest rates. Interest rates obviously do cycle over time. You can see these gray bars represent major economic changes. This is the housing crash of 2008. You have the pandemic in 2020, 21. And so, one of the things I would just kind of encourage our class to think a little bit about is, historical averages on interest rates are in the high fours to low fives. Not likely that we're going to return to anywhere close to what we saw in the pandemic years of 2.5% interest rates. It's just probably not going to happen unless something was really catastrophic happening economically. So, at this point, we will see interest rates go down lower. It's not more of an if, it's more of a when type of situation based upon some of those economic factors that we're kind of managing through. Now, interest rates have different characteristics to them. Things like credit score, my eligibility for a specific loan program, the type of product I'm going to elect, how much I decide to finance, what my down payment looks like. We didn't get a chance to talk about this earlier in our rent versus buying calculator, but as a consumer, you can pay additional funds out of pocket in order to bring down your interest rate. We call those discount points. We're essentially paying more expenses out of pocket in order to bring down my interest rate. Usually 1 point is the equivalent of 1% of my loan amount, which will generally reduce my interest rate about 0.25%. Now, in today's market, where many of our clients that are purchasing with their financing tools today have higher interest rates because of just where the market's at, many of our clients will be looking to refinance in a couple years. So I don't really recommend clients investing in discount points today because they're probably going to turn around and refinance in a couple years. And the reality is the break-even point for most clients paying points is about 3 to 4 years. So it doesn't really mathematically make a lot of sense. The other characteristic in interest rates is loan terms. So the shorter my loan term is, the lower my interest rate could be. So if today's rates are 6.7 to 6.8, if I shrink my term down to say 15 years, my rate may jump down to maybe 6.25%. At the same time, my payment's going to be much higher, right? Because I'm not doing a 30-year loan, I'm now shrinking it down to a 15-year term product. Now, as I get a chance to meet with our clients and design their home buying plans for them, we're going to figure out what's the right structure of the loan product for them. So we're going to figure out based upon eligibility for a specific product, what's that interest rate look like, what's the term going to be, and ultimately, how do we get to an affordability budget level for you, right? So that's kind of what interest rates look like. Now, one of the bigger factors that plays into interest rates is credit. And so as we prepare for home ownership, I want to give you a little bit of insight into credit from kind of the lens of the mortgage side of things. Now, every loan program does have a minimum credit score, and you can see some of these products that we're going to spend some time talking about here in just a bit. Those are the minimum credit scores for each one of those products. I'll give you kind of a look at those in just a bit. Now, there are 3 agencies that report scores, and I think you guys are all aware of that, right? So we have Equifax, TransUnion, and Experian. Each one of those agencies report a different credit risk model. So your scores are going to look different in each one of those agency products. And there's also 3 different models within those agencies. So if I go to apply for a credit card, there's one model. If I apply for a car financing, that's the second model. And then if I'm going to apply to have my home finance, then there's a mortgage model, which of course that's the model that we use for scoring. So if you have Credit Karma that you're using for your monitoring tool, which is great, right? That gives you great visibility to your score. That is going to use a credit card score. But if you apply for a mortgage, you're probably going to see some variation between those scores just because the risk calculations look a little bit different. Now, for some of our clients that have had maybe some late payments in the past, or maybe some recent, over limits on their credit cards, whatever event is going on your credit profile, generally that's going to have an impact within the most 12 to 24 months from the date of the event. So if I had a late payment, let's say on a student loan back in October of 24, I'm still inside of 12 months. So I'm probably having some impact to my credit score. But as I get further and further away from that date of the event, I'm probably going to see my score kind of organically go up. So usually in the most recent 12 to 24 months is my impact to my score. We're going to talk a little bit more about different aspects of credit, like utilization of credit, like revolving credit limits versus balances. And I'll spend some time talking a little bit about account history. One thing I just did want to spotlight for you is that, each one of those credit agencies that I just mentioned have a different score, right? We do take the middle score of all three agencies reporting. So if my highest score is 760, let's say my middle score is 740 and my lowest score is 720, we're going to take 740 as a score we use to determine eligibility for a buyer. Now, if I have a spouse or a co-signer that's going to be a part of the financing, we look at their scores as well, but we take the lowest middle credit score between both borrowers. So let's say if I'm at 740 with my score, but my partner has 700, 680, and 660, well, their lowest score is 680, which is lower than my middle score. So the 680 is the score that will be used for qualifying purposes. So that'll determine my interest rate. That'll determine, the type of product I might be eligible for. So that plays a big role in what that could look like for me with my qualifying. All right. Now we're going to coach you through credit as part of our consultative process to show you what's maybe areas of opportunity on your credit and see how where your credit score is at today may affect or impact your choices in financing. Now, negative items that appear on your credit, this is kind of a matrix that shows you how long they'll stay with you on your credit. So that kind of gives you a sense of like hard inquiries, for example, will be on your credit for 2 years or less. The impact of the score, though, will be in the most recent 6 to 12 months. You can see things like late payments, again, 7 years appearing on the credit report, most recent 12 to 24 months. Now, one of the unique things that we do in serving our clients in homeownership is around how we manage credit inquiries. So as we prepare for homeownership and we pre-approve you for your home buying plan, we only start with a soft credit check. And the reason we do that is because we understand, especially working with first-time buyers that come through our classes, that they have maybe a longer cycle time of buying, right? So it might take them 6 to 12 months, maybe longer, right? So we don't want to impact their credit score. So we always start with that soft credit check first. Here's kind of what the weighting of the mortgage score calculation looks like. So this will kind of help maybe identify areas of opportunity for you in your own score. So the first is looking at how long have I had credit. So 15% of the weighting is what my length of credit looks like. So the more mature my credit file is, probably the better my credit score is. So if I compare maybe a client that's had credit for 6 months versus someone that's had credit for 6 years, that 6-year credit history is probably a little bit higher, right? The next weighting, which is around 20%, is new credit, new accounts that I'm trying to open. Also, I just mentioned to you about hard inquiries. Hard inquiries will also impact that 20% weighting, not soft inquiries though. So if I'm opening up, a lot of accounts, maybe 2 or 3 accounts in a short period of time, like 6 months, I'll probably see some pullback in my credit score versus another client that really hasn't opened up a lot of accounts in the last 6 months. They just kind of maintain the existing accounts that they have. 30% is going to be around credit utilization. So we're specifically looking at revolving accounts. So taking a look at revolving credit limits that are accessible to me versus what my actual balances are. So we want to generally have those balances, well, optimally to be below 10% of the credit limit. So if I have $10,000 in limits and my balances are $1,000 or less, I'm in a really good spot. I probably have a higher credit score. But if my balances have floated up to 60, 70, maybe 70, 80%, I'm at, $8,000 in credit balances on those $10,000 in limits, I've probably seen some pullback in my credit score. Now, if a client is kind of running a little bit higher in credit utilization, we would encourage them to try to push that debt down to at least 50% utilization. That'll give us an uptick in our credit score, and then ultimately work to a 30% utilization or $3,000 in balances, and then ultimately try to get to $1,000 or less, right? Now, here's a quick little tool or tip, if you will, to manage credit card debt. So when you take a look at one of your credit card statements, there's usually 2 dates that appear. There's the billing cycle date. There's also the due date, right? Now, many of us probably just make our payments on the due date, don't even think about it, totally fine. But the trick for this approach is that if you can try to pay off or pay down your credit cards before the billing cycle date, what you do by taking that approach is that you lower your balances and you show a better utilization before the credit card companies are able to report your information to the agencies. Because at the end of the cycle date, all of your activities close out on that credit card and gets reported out to the agencies. But if you can kind of beat them to the reporting, then you're going to have a much lower utilization of credit because of a lower balance and, of course, a much higher credit score. Last thing on the weighting is 35%. It's called payment history, right? So how have I paid my bills? We're really looking at the last 12 to 24 months of pay history. If you've had late payments, they get rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. So the more severe that late payment is, probably the bigger impact I'm going to have to my credit score. All right. Any questions so far on some of our talking points at this point? I know we went through credit briefly. We talked a little bit about, market analysis and whatnot. If you have some questions before we hop into student loans, feel free to drop those into the chat or the Q&A, and I'll make sure I get those answered for you on air. All right. Okay, cool. So let's talk a little bit about student loans, because many of the federal student loans that were previously on forbearance are coming back online for payment. So, a lot of my clients are starting repayments in July and August. And so I know, things are still trying to get sifted out with forgiveness of student loan debt, but ultimately a lot of these payments are coming back online. Now, if you're going to be in an income-based repayment program, we can take that payment for qualifying. So in our example on screen, if you have $75,000 worth of student loan debt and you're paying $250 per month, that $250 payment is what we can use for qualifying. Now, some clients are not back in repayment because maybe they're still in forbearance or deferment. Now, by default, depending on the product that we're going to do on an FHA loan, we have to take 0.5% of the balances as the payment. So if I'm going to, look at $75,000 worth of student loan debt, that FHA loan is going to require a minimum payment of $375. On a Fannie Mae, Freddie Mac conventional loan, it's 1%, which in this case would be $750 per month. So that can change the qualifying. And we're going to help kind of talk through student loans with you as part of your consultative process. But one of our takeaways, I think, should be in the student loan section, because it gets a little bit confusing for clients, is that if you are still in forbearance or you're still in deferment because maybe you're back in school taking a few classes, we still have to count a minimum payment towards qualifying. But if you're actively repaying and you have an income-based repayment program, we can use that payment right away. Now, I did have a question that came in the chat, which is, how long do credit inquiries stay on the report? So we had it on our matrix, and we'll send it back out to you again, but it's 2 years that they're going to stay on your credit report. The impact on your score is in the most recent 6 to 12 months. So there are rules in credit reporting for inquiries for both mortgage and auto financing, which states that you can apply for an auto loan, for example. That one inquiry starts the clock for a 30-day window of time, and you can shop around with as many lenders, and it's the equivalent to one inquiry hit to your score. Same thing applies to mortgage financing. All right, thanks for the question. Let's talk a little bit about different loan programs that are available to you, all of us as first-time buyers or even second or third-time buyers. So we're going to give you kind of a high-level look at each one of the programs. The first product is a conventional loan. When you think about conventional loans, you're thinking about Fannie Mae, Freddie Mac loans, and that Fannie Mae and Freddie Mac's been in the news a little bit because the administration's talking about taking them and privatizing them. Right now, they're kind of under conservatorship of the U.S. government, just because of the housing debacle of 2008. That we'll see, remains to be seen if that's a positive thing or not in privatizing Fannie Mae and Freddie Mac. But ultimately, they control about 60 to 70% of all originations across the country. The minimum down payment for a Fannie Mae Freddie Mac loan is 3% of the purchase price, minimum credit score of 620. And every year we set a conforming loan limit amount, which is 806,500. That's directed by FHFA. And so we get a sense of what that looks like right around September, October, based upon kind of cost of living across the country. Next product is an FHA loan. That is a government insured loan. FHA stands for the Federal Housing Administration. That has a minimum down payment of 3.5%, a little bit lower credit score at 580. Now, the loan amount for FHA will vary based upon where we're at in the country. So each county has a specific minimum loan amount. Now, I want to just spotlight this product just below FHA, which is USDA, because these are both government insured loans. Now, USDA is a rural product which allows buyers to purchase in deemed rural areas. There's two qualifiers for USDA eligibility: is the location of the property has to be rural, as per the USDA, and there's income limits based upon the household size. Now, those loan amounts vary based upon location, very similar to FHA, and this is a backed loan by USDA. Now, FHA and USDA have had changes as of May. Because they are government insured loans, the administration has made changes to the guidelines of these programs, which unfortunately has made changes for eligibility for borrowers. So if you're a non-permanent resident, there's not eligibility for a government insured loan. However, it still eligibility exists with a conventional loan. It's just not under the government insured loan. So if you're a non-permanent resident, unfortunately, we don't have access to the FHA or USDA products. The jumbo loan is going to be for clients that are looking to purchase with basically larger financing needs. So it has a higher down payment requirement, generally higher credit score requirements. Not really typical for some of our first-time buyers, but certainly it's an avenue that can be a resource for those that need to purchase at higher levels. And then VA loans are for our veterans that have eligibility under the product. The cool thing about the VA product, it's a zero down payment option, minimum credit score of 620. There really isn't a cap on how much we finance because we want to have as much accessibility for the veteran. So we can go up to as high as $5 million plus in amount finance, and is reserved for our veterans that have eligibility under the product. For veterans that have any partial disability from the VA on their certificate of eligibility, which shows their eligibility for the program, if they have any type of partial disability, there's an exemption to what we call as a VA funding fee. Now, another product that's not listed here is our physician's home loan, which allows those that are currently in residency or actively practicing, whether that's dentists, veterinarians, physicians, whatever the case may be, allows them to get a physician's loan that gives ultimately some benefits to them in terms of like student loan debt, for example, not counting against them how Fannie Mae, Freddie Mac, or FHA would look at, a little bit more ease of qualifying. So for those of you that might be interested in that product, we can spend some time at the latter stages of our class talking about that, or certainly we can talk offline. Before I get into PMI or private mortgage insurance, I did get a question in the Q&A, which is how much of our budget should we be set apart from housing maintenance? How much of our budget should be set apart for housing maintenance? So it really just depends because, if you're going to purchase an older home, then you probably want to set aside a little bit more for maintenance costs and upkeep of your home. It's really kind of hard to judge that one just as kind of a general, what if number. Generally in our calculators that we have clients budget about $1,000 plus for maintenance. But, if I'm buying a 2015 property versus a house built in 1940s, obviously the maintenance cost is going to look a little bit different. All right, let's talk a little bit about mortgage insurance. We get a lot of questions about this from clients. Ultimately, what mortgage insurance is doing is protecting the lender in case of maybe economic challenges from the buyer side. So it essentially is providing insurance to the lender. However, the consumer is responsible for paying that. Now, there's different ways that mortgage insurance is set up. On conventional loans, it looks a little bit different than on government insured loans like FHA, for example. So let me walk you through both just so you can get a sense of what that looks like. Conventional mortgage insurance is called PMI, or private mortgage insurance. So there's about 7 or 8 companies nationwide that provide specific insurance for the lenders. Now, the premiums that you pay as a consumer are based upon a few criteria. They're based upon down payment. It's based upon what your credit score looks like and how much you finance. So the higher my credit score is, the larger my down payment is, the lesser my mortgage insurance costs are going to be. Now, one of the benefits of conventional mortgage insurance is that when I reach 2 years in my loan and I have 22% equity, I can apply to have my mortgage insurance canceled. Okay, so that's a big part of conventional. And one of the kind of misconceptions that I see from a lot of clients, in fact, I just had a consultation with a client this morning, was, if you did some searches on Redfin or Zillow and used some of their calculators, many of their calculators aren't set to some of the search criteria that we have here, which can make the premium a lot less than what you see in online calculators. So for example, if I'm going to buy and finance $450,000 and I'm doing a 30-year fixed mortgage with, let's say, 3% down, my premium's probably around $138 per month. Whereas looking online at some calculators, you might think it's $200 or $300 a month. So it can be a lot more affordable than you think. And of course, if my score is higher than 740, if it's 780, maybe even 800, that premium could be actually even less. Now, on the FHA side of things, FHA is a government insured product, as we mentioned earlier in our products segment. Now, there's 2 forms of mortgage insurance on FHA, which doesn't always get talked about. There's monthly mortgage insurance that's a factor of 0.55%. And then there's also more upfront mortgage insurance, which is 1.75% of my loan amount. Now, with FHA loans, different than conventional loans, there's not a cancellation option. So we're usually going to think about the FHA product as more kind of a short-term product for our clients to get access to homeownership, because FHA is going to have a lot more flexibility from a qualifying perspective than we might see from a conventional guidelines perspective. Now, if we look at the FHA mortgage insurance calculation, let's say we're financing that same $450,000, our upfront mortgage insurance would be $7,800, and then our monthly mortgage insurance would be about $206 per month. So FHA is going to be a bit more expensive in terms of upfront costs. By the way, the upfront mortgage insurance gets financed into the total loan amount for the client. So it's not directly impacting out-of-pocket expenses. But if we go FHA, we are borrowing more costs or borrowing more in terms of financing. So the question I get often is, what would make me choose one product over the other? Well, ultimately, we're going to think about qualifying, right? Because every product selection is going to have guidelines attached to it. As you learned a little bit earlier in the product segment, FHA is just going to be a lot more lenient credit score wise than say conventional loans, or like maybe I had a past delinquency on a student loan. FHA would probably be a little more flexible with that than say a conventional product. So we're going to figure out in our one-on-one session what the right match is for you, but ultimately that kind of gives you an idea what that comparison looks like. Now, as we look at products, we also determine income eligibility to those products. So we're going to kind of pivot a little bit now and talk a little bit about income and expenses as it relates to home ownership. Now, we always have to document income for clients. That includes things like W-2s, pay stubs, sometimes tax returns, especially for self-employed clients. So if you are self-employed, we definitely have to provide 2 years of tax returns, and then we do an analysis of what the net income looks like for the business. Now, in financing, we also have to validate 2 years of work or educational background history, right? So there's kind of a misconception, if you will, when we talk to clients around how long do I have to have on my job. There really isn't a restriction of how long I have to be on my job. I just have to show a history of at least 2 years between my employment and or education. So I could have been on my job for 6 months and maybe just graduated from UF in the fall. That's totally okay as long as I can chart that past history of at least 2 years. Okay. Now, when we think about that 2-year requirement, there are exceptions to that. For example, if I'm in a position where I work at 2 locations for 2 separate employers, in that case, I do have to demonstrate 2 years on the job with both locations in order to count both sources of income. All right. If I'm self-employed, I have to show 2 years of tax filings consecutively in order to count that self-employment income. If I work maybe a 40-hour work week job and I also work part-time for another employer, in order to count both streams of income, I do have to show that I've been on both jobs for 2 years. We also see that same rule apply if I'm working, my 40-hour work week job, but on the weekends, I like to make a little extra cash and work for Uber, right? If I want to introduce that Uber income, I have to demonstrate that I can basically hold down 2 jobs simultaneously for a 2-year span of time. All right. Last thing I want to talk about on income, and by the way, we've provided you some of the documentation requirements here as well. But the last thing I want to kind of comment on is 2 things. One is going to be income sources like bonuses or overtime, RSUs. Those can be variable sources of income. So in order to introduce those sources of income for qualifying for a mortgage, we generally have to be on the job for 2 years. And if we have maybe ancillary income sources, like let's say my partner contributes to my household income, but doesn't plan on being on the application, in that case, we can't count that income unless my partner is obviously choosing to be a part of the loan application. Okay. Question came in the chat, which is how long do you need to have a job for current income? So great question. So there really is no time span. So we can actually qualify clients. In fact, we have a client we're meeting with this evening. They're not starting their job for 2 months at a different location. And so we can actually qualify them off of their executed offer letter as long as we know that, the timing of their job starting and whatnot, and they're fully ready to start. So there really isn't a requirement of that. We just have to be able to document the start date. Okay. All right. Thanks for that question. I'm glad you brought that up. Now, we also compare income to expenses. We call that debt to income ratio, which is looking at existing expenses like maybe my credit cards, personal loans, maybe my car loans, some of those student loans we talked about. But I also factor in my new housing budget. So if I look at the principal and interest of my loan, the taxes, the homeowner's insurance, maybe I'm buying a condo in, Gainesville and I have a $400 HOA expense. Well, let's factor that into the equation as well too. So we look at all those expenses and then we divide that by what our pre-tax income looks like. So you can see a calculation that we did on screen here. So this is an example of a client that has $3,000 in expenses and they have an $8,500 pre-tax monthly income, right? So in that case, our calculation, which we call debt to income ratio calculation, tells us that 35.3% of my expenses are taking up in that income space, right? So, or you could look at it, 35% of my income is being consumed by expenses, right? So the maximum qualifying is generally 45 to 50%. That's the highest we would want to see those expenses. Now, I would say an optimal level, or maybe the sweet spot for most clients, is 33 to 36%. So, this would be an example probably of someone that's, in kind of more of a comfort zone. We had a question earlier in the chat, which is, what should I budget towards maintenance costs? And, that's not factored into this calculation, but I think ultimately this expense right here that we see, or this calculation, kind of tells us more about qualifying for us, because to that point is that there's a lot of expenses that are going to come along with home ownership that we're not going to factor into your eligibility. So that's why when I meet with clients, we're going to have a conversation around affordability, because you may qualify for a $3,500 mortgage payment, but the reality is that it's too high for you. You need to be at $2,500 based upon maybe really some of the lifestyle expenses that you have. Maybe you feel like, hey, feels good for me because I need to save at least $500 a month, whatever the case may be. And so those are conversations that you and I will have as part of a consultation. Now, the last component to figuring out home ownership is really savings for home ownership, right? And that's probably next to credit, one of the biggest challenges that most home buyers have, because maybe I just started my job and I just don't have those resources available, or maybe I don't have family that can help support me in home ownership. So we're going to spend some time talking about first-time buyer programs in just a bit, but I just want to give you a sense of what are some of the ways we validate resources for home ownership, like what kind of assets you can use. And then I want to give you a little bit of a savings plan to approach in home ownership. So the first thing we look at is, checking in savings accounts. Obviously, those are cash accounts. Those certainly can be used. We're going to do an analysis of the last 60 days of statements. So if there's any large deposits in there, we have to kind of track all of that stuff. 401ks can be potentially used. 403bs, retirement accounts, brokerage accounts can be used. We encourage clients, talk to your financial or tax advisor before you get access to those assets. Family members can help in home ownership. There really is no seasoning requirements to those types of assets. We just have to document how those gift funds are getting distributed to the transaction. So it just can't be cash, but as long as we can, chart where those funds are coming from, then they can certainly be used in home ownership. Now, let's talk a little bit about savings. And actually, before I do, I just saw a question pop in the Q&A. So let me just answer it really quick. So you guys, if I switch back to our previous screen, you can see there's a note here about approval is based upon automatic underwriting. So there's automatic underwriting systems that are used in financing offered through Fannie Mae, Freddie Mac, and FHA, VA, you name it. Manual underwriting, which is the question we got in the chat, those can be used. So manual underwriting is essentially when something falls out of the space of automated underwriting guidelines, we can manual underwrite, but then it shrinks down some of the qualifiers. Like, for example, the debt to income ratio generally can't be as high when it comes to qualifying. So Zach, to answer your question, yes, we can do manual underwriting, but there'll be some kind of caveats to that, if you will. Okay. All right, thanks for the question. So let's talk a little bit about savings plan for home ownership. So as I consult with clients, we may be in a really good spot to be able to afford that mortgage payment, but maybe there's a gap there in terms of like how much we can put down towards the home, right? And so that can be really a challenge, maybe because we're new in our careers, or maybe we're just trying to really tackle some debt right now, whatever the case may be. But I want to give you guys a really simple savings plan approach that I think works pretty effectively for clients. So if I have, just as a what if scenario, let's say I'm paying $1,500 a month in rent, but with my new job, I feel like I can get to $3,000 a month on a mortgage side because I think I can do that. I'm just lacking the savings. What I would encourage our clients to do with those numbers is to start creating a savings plan for myself every month that I'm essentially saving like I'm actually paying that $3,000 mortgage. So on the first of the month, I transfer the money to my landlord for $1,500 a month, but I create that discipline that extra $1,500 is also being transferred to my savings account So it's ultimately like I'm paying the $3,000 mortgage payment, but I'm growing my savings over the next several months, but I'm also creating the discipline and the behavior of like I'm making a mortgage payment at that level. Because let's face it, there's a little bit of a payment shock for clients when they transition from renting to owning. So, after 6 months, I might probably have $9,000 in my savings account. After 12 months, I'm up to $18,000. So that's a great way to kind of start up that plan of home ownership. So that's just a really simple approach in savings. Now we had another question that came in, which was, what do you mean by no cash in the down payment? So when we say no cash, meaning cash like cash, like dollar bills cash. So we can, and we have to be careful in real estate transactions. We have to chart all funds or that are used in financing. It's part of the requirements. So if you have a cash deposit of $5,000 and it's within that 60-day period of time and we can't validate where the money came from, then that would not be allowed in financing. Or you can't, show up to buy a house and, hand $1,000 in cash. That's not allowed in home financing. All right. Thanks for that question. I'm glad that's good that we got a chance to kind of clarify that. Let's talk a little bit about first-time buyer programs, and we'll talk specifically about Florida. I think most of our class is in Florida, but if we're outside of the state, we can certainly dive into other programs at your leisure. But let me just kind of give you a quick little snapshot of some of the resources available in Florida. So as I mentioned earlier, most states have HFAs. So the Housing Finance Agency, Florida is no different. So the Florida Assistance Program provides up to $10,000 in assistance, which is basically a deferred payment that doesn't be paid back until you either sell or if you refinance in the future. So that's a great resource. The Florida Homeownership Program provides $10,000 in assistance as well. That is a forgivable program after a 15-year term. So that's another resource that we can see if it makes sense for you. And then there's an HFA Preferred or HFA Advantage program, provides up to 3 to up to 5% of the purchase price in assistance for eligible buyers. That is a forgivable assistance program. Generally, after 5 years, it's forgivable. And then the Florida Hometown Heroes Housing Program is eligible for basically first responders, healthcare professionals, childcare employees, active military and veterans. Give special incentive and discounts for some of those hometown heroes. So that's a lot of great resource there. Depending on what you qualify for, we'll kind of match you to one of those Florida programs if it makes sense. Now, every one of those programs does have income limits. Those income limits are based upon the county that you want to purchase in. Okay, so we won't be able to obviously go through everyone's scenario today, but as we do a consultation with you, we'll figure out if one of these programs match for you. Now, nationally, we have a Pathway DPA program here within APM, provides anywhere between 3.5% to 5% of your sales price in assistance. So that can be another tool. Those are totally separate products from the Florida FHA product, but it's certainly something that can be incorporated into your home buying plan. All right, our last topic tonight is going to be talking about the buying process. Where do we go from here? So hopefully you've got a lot of great takeaways from tonight's class, but where do I kind of now put this into action? So, from this class, we would encourage you to get connected with me for your free online consultation where I get a chance to meet with you to design a comprehensive home buying plan. That's what I spend most of my time doing with clients that we're not teaching classes to, just helping you figure out what your budget looks like and maybe credit opportunities and kind of mapping out like what home ownership looks like for you. Whether you want to buy next month or next year or maybe 2 years from now, we want to help kind of chart that course for you in home ownership. So that's kind of the next step from today's class, and you'll get more information on how to do that. From there, we start kind of the 6 steps of home buying process. Step 1 is the output of that consultation. That's to be pre-approved for your home mortgage. That essentially is identifying your eligibility to go out and buy a home. Usually that pre-approval is good for 60 days, but it can be recertified at any time. So when we work with clients, there's no pressure to buy. We just want to kind of create a roadmap for you. And then when the time is right and you feel like you're financially fit and ready to go, you can start, really seriously searching for homes. And that's the next step in the process. That's the home search. So we're going to generally partner with a realtor that we trust, and we have some preferred realtors that we can introduce you to that help you as a resource. When you select a realtor, they should be experts in their market. I would say experts in negotiations, and have some great business partners that they can align with for things like inspections and whatnot. As you work with your realtor, that it'll probably go from online to in-person viewing of properties. When you're ready to make an offer on a property, that's where we kind of come back in. As you're considering different options for financing, we're going to work with you to figure out, make sure the numbers are right for a specific property. Now, once we've got that kind of dialed in, then if you do decide to make an offer on a property, that offer might get accepted. And right now, there's a high probability of acceptance because there's a lot of good supply out there for our buyers. Now, if that seller accepts your offer, that moves you to step three. So that means you now have a ratified agreement with the seller and it starts the escrow process. In most parts of the country, that's a 30-day process. So to go from accepted offer to get the keys to your home, it takes about 30 days. Now, that same day of your acceptance of offer, you're going to get a call from myself saying, hey, congratulations, you did it. Now you have an accepted offer. Let's walk you through next steps and let's schedule you for your follow-up video session so we can kind of do all the fine tuning for you on your financing. Now, you also have some action items on your side at that time. You're going to generally start getting current documents together for your financing. You also need to make what we call an earnest money deposit for your property. Usually that's 1% to 2% of your purchase price. Those funds will count towards your total out-of-pocket expense, but there are some action items that happen in the first couple of days for you as a buyer. Now, we continue to move down through this buying process. You can see a little bit more about the earnest money deposit. Step 4 will take us into learning more about the administrative process. But before we get there, part of your contract includes what we call as contingencies that allow you as a buyer to do some investigative work on your house to make sure that it's right for you. That includes getting your inspections done, and there's a variety of different inspections you can do. We want to get your house appraised to make sure the value supports the purchase price. And we want to, of course, get your loan approved to make sure the financing is all set up for you properly. So step 4 is going to now take us down to the next step, which is essentially verifying employment, assets, verifying your program, delivering disclosures to you to make sure everything is set up properly. And then we continue to move through this process. Now, throughout the duration of the process, you're going to be getting electronic disclosures from our team. Everything is essentially electronic in the process. However, you'll hear in just a second, step 6 is going to be the only in-person component to your process. Step 5 takes us almost 3/4 of the way through the buying process. An underwriter has now reviewed your loan, approved your loan. We probably have your appraisal back, your inspections are done. Probably also takes you to the end of your contingency period. And if you feel comfortable with the outcome of those inspections, appraisal checks out, approval's good, then you're going to have the opportunity to sign off on your contingencies with your transaction. Part of being 3/4 of the way through the process, we're going to finalize your cooling off disclosure called a closing disclosure. Why it's called the cooling off period is because it gives you 3 days cooling off before you go to the final stages of the process, which is the in-person part of our process, which essentially is signing documents with an attorney's office or title officer. On that day, you're going to have a block out about an hour of time. That same day, you'll also fund your final amount of money due for your transaction. Those monies get all kind of reconciled along with the loan funds you're receiving from APM. And once that's all kind of balanced out, then they record documents with a local county recorder's office. They record a grant deed to transfer ownership to you, as well as the deed for the loan that you're taking out. And once we get confirmation that all of those items are recorded with that county recorder's office, then we get a chance to make our favorite call of the day, which is say, hey, congratulations, you're now the new homeowner. And it's a big day of celebration because it's a huge accomplishment. We get a chance to celebrate with you to meet one of the major financial milestones in your lives, right? Now, our relationship doesn't end there. Part of our aftercare, we're staying connected with our clients through our HomeBot system to help you understand about your equity position in your house, our rate watch system to see what's going on for refinancing opportunities down the road. And we always love to kind of stay connected with our clients with annual check-ins because let's face it, things always change for ourselves financially. So we want to make sure that we can be a resource for you whenever those changes happen. Hopefully all positive changes, right? So that's kind of a little bit more about what our process looks like for in working with our clients. Now, if you're thinking about taking those next steps in homeownership and want to design your own plan for homeownership, again, this is a free service we provide as kind of the next steps from our educational classes. It's a real simple 3-step process. It includes doing an online application, which you can see the link there on today's slide. You will upload proof of your income. And then you'll use our scheduling system to schedule a convenient video call that works good for you. We only start with a soft credit check. Again, this is a free service that we provide. So, our intention is not for you to run out and buy a house tomorrow. It's just to provide you a roadmap to home ownership. So when, things are in the right position and it all aligns for you, that you understand what your qualifying looks like and you're prepared to go out and look for homes. Okay. Now, in fact, after tonight's class, I have a couple UF alum that we'll be meeting with tonight to design their own home buying plan. So hopefully I'll get a chance to meet with each of you at some point in time. Now, here's what our free consultation service looks like. Developing a plan for you around budget, location, assistance programs, credit opportunities. So I'll help you with some credit coaching, looking at some asset management, like how much assets do we want to put towards our purchase? Maybe there's some strategy around income that we got to talk about, but that's a 30-minute block of time that we're going to do a deep dive into helping you qualify for your home financing. Just want to kind of point out really quick our mobile feature. So we understand the value of technology and we leverage that through our mobile platform, but we also create a high touch human experience, right? So, we're always available via text, call, email for our clients, but mobile can be a great way to, kind of follow the progress of your financing, as well as just even doing the simple calculations to learn more about what payments could be like on your home mortgage. As I wrap up, we have a couple minutes before the top of the hour. Just wanted to mention to you your discount that you receive as a UF alum. And as our partnership, we discount our services by $750 in closing costs to help make things more affordable for you. Of course, you have access to our free classes that we provide 4 times a year. And, just obviously getting a chance to meet with us for your free consultation. Now, if you have friends, family, or coworkers that you think might benefit from our class platform, they can to attend one of our open classes. You can see some of our other partnerships spread out across the country. So feel free, if you have friends or family that want to check this out, they can always go to mortgageeducate.com. I think we have probably at least 40 classes left on the calendar for 2025, and we'll have a full slate for the upcoming year as well. Here's all my contact information. So if you do want to reach out to me, feel free to do so with one of those methods. And then finally, just like to kind of point out, we're going to have tonight's class, which I think was on the chat just now. Tonight's class is recorded, so that'll be up on our YouTube channel tomorrow. So you can do a look back or share that link with friends or family. And you can kind of check out some of our socials to see kind of what we're talking a little bit about in home ownership. We're trying to post consistently, especially on our Instagram, about what's going on economically. How can you benefit from resources in home ownership? So if you get a chance to follow us on Instagram, we'll put out some good content there for you as well. So that brings us to the end of tonight's class. I appreciate everybody being so attentive and asking some really great questions tonight. Hopefully you have 1 or 2, maybe 3 takeaways from tonight's class that'll help you on your road to this financial journey. Before I leave in tonight's session, I just want to ask to see if we have any other questions from our audience. And thank you for that. So if you can just drop those in the Q&A. So thank you for the positive feedback. Yes, we are going to send out the presentation to the whole group as well. So I know many of you that signed up for tonight's class. We had a big sign up turnout. Didn't get a chance to get on today's live session, but we'll have all the material out to everybody who signed up. Right. Let me just make sure I'm not missing anybody. Okay, cool. I think we got that. Any other questions from our class? Okay. Well, I thank you so much for spending your Thursday evening with us. Again, hopefully you got a few great takeaways from tonight's class. Thank you so much for being a part of this journey with us, and hopefully get a chance to connect with all of you soon. Have a good night.